So now I want to talk about AROs. AROs it's the acronym for Asset Retirement Obligations. These are contracts that are tied to specific assets regarding how they are going to be disposed, how we are going to retire them. Now, most commonly, this is going to apply to natural resources. It's not exclusive necessarily, but commonly going to be applied here. We're going to tear down a factory plant at the end of its useful life, or we're going to reseed a forest, or tear down an oil drilling site and fill the land and get it back so that there's not earthquakes, which probably is inevitable now. Oklahoma is like earthquake central after all their fracking. Now we look at how this is recorded. We record it at the PV, which stands for present value. The PV of expected future cash flows, right? We capitalize that, we debit to the value of the asset. So here we're debiting the asset that the ARO is associated with. So this is my PP&E asset, and it is the one that's associated with the ARO. We debit it for the present value of the ARO, and then we also credit a liability account that's called asset retirement obligation. Now, most of the time, these are going to be long-term liabilities because we're going to likely use the, if we're using the asset for more than 1 year, then the asset retirement obligation waits, right? That obligation is not due until we're done with the asset. But of course, they can eventually become current because at some point they will be due within a year, just not when we acquire it. The future value of the ARO will be less than its present value. So this comes back to the time value of money. It's just a known fact because of interest that $1 today is worth more than $1 in the future. Because at the very least, I can take that dollar and put it in an interest-bearing savings account. And even if it's minuscule, which it would be extremely minuscule, I mean, they are raising interest rates now, but still very minuscule, there will be an enhancement to the value of the dollar because it's sat for a day. So I'd rather get money today all the time, every time, than money in the future. That's why, for example, if you go for like the full lottery winnings, the moment you win it versus annuities versus, allotments of money over your life, you'll get less money today. Because you can use it then, and especially if you have that much money, you can definitely earn some crazy interest on it over time. Accretion expense records the growth in the present value year over year as the obligation of the ARO gets closer to its future value. And so what we have, right, if it basically first we're recording it at the present value of the ARO. When we record it, let's say that the future, I have $300,000 due in 3 years. So we got at the end of year 1, end of year 2, end of year 3. And here's my $300,000 mark. So in time value of money terms, this would be denoted as my future value. Because in the future, I'm going to have to pay $300,000 in order to satisfy the obligation of retiring this asset. So I'm not going to come up with a specific present value because I can't off the top of my head without a calculator or a table, but we'll just say this is the present value of $300,000. Remember, $300,000 3 years from now is less money today because money today is worth more than money in the future. So maybe it's like, let's just make up a number, $265,000 today is the equivalent of $300,000 in the future. Right? Over time, when I'm now only 2 years from the end, right? Year 2, year 3, the amount of money today is a little bit more because now we're only 2 years in the future. You can think of it this way. Another way to think about it is, well, how much money would I have to invest today at a certain interest rate to get 300,000 3 years from now? Well, that's here. Well, if I needed to get 300,000 2 years from today, then I would have to put in more money. And if I wanted $300,000 just a year from today, year 2, I would have to put in even more money. And so over time, the present value of this obligation grows. And what we're recording with accretion expense is this growth year over year. So for the first year, the accretion expense would be the amount of money that the present value of the obligation rises by because 1 year has passed. So that's what accretion expense is. And when we debit it, we credit the asset retirement obligation. Accretion expense is net income. It reduces net income. It's an expense. And the asset retirement obligation is still a liability. We are increasing the liability directly to show that its present value has now been increased. The way we come up with accretion expense is by taking the book value of the ARO, and it's also sometimes called the carrying value, but let's just stick with book value. The book value of the ARO at the beginning of the period, and multiplying it by whatever the discount rate was, whatever percent interest that we decided was reasonable, a reasonable credit rate for this company and their obligation. And that fills in the XX. So let's look at an example of it, how this is sorted out, because this is a new piece. Orion contracted rights to get resources from a mountain, the cost of the permit, legal fees, all of that over the minerals was 200,000, cost of permits and legal fees. So permits were 200, legal fees were 150. We had to explore, that's 950, digging and shoring, including digging and shoring the necessary network of tunnels. In order to harvest the materials, they acquired $20,000 of carts and $10,000 of steel railing. The company believes the carts may be transported to other harvest sites, but it cannot reuse the railing. So remember that when we're looking at these costs, really kind of go for some buzzwords like contracted rights. So we're looking for the rights, and that includes permits and legal fees, exploration, harvest. Those are those words that said, hey, these costs should be capitalized. All costs of acquiring the resource and the rights to the resource, discovery, exploring, and harvest extraction. So lots of these things are going to be included in the cost of my natural resource. And in including those, the only ones that we might have some different fixed asset for is that we're actually getting some carts and some steel railing, i.e. some like mining equipment in order to make this work. So those could be their own individual assets. They're not just costs that have been spent to acquire the resource itself. Okay. So we add these together, we got 200, 150, that's 350, add 350 to 950, that's $1.3 million. Together would be my natural resource. That includes the 200, the 150, the 950. And then we also have these assets. You can, I mean, you could list them separately. You could combine them. I'm just going to combine them. So I'm not writing a ton of debits here. We got some equipment that we would value at 30,000. And it says that, you know, the carts can be transported, but the railing cannot. So the railing would be limited to useful life of the resource, and the carts can have the independent useful life. They have their own useful life, not limited by the resource. We're not going to do the depreciation, but again, just kind of keep that in your head, why, you know, what that means, when I can use them for other things and when I can't. And then assuming cash, if I don't, you know, assume cash is the default method of payment unless I mention something else, so that it simplifies things. I don't have to say cash, 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 cash every time. So that would be the journal entry before thinking about the ARO. But now let's assume there's an asset retirement obligation attached to the excavation. And it says, hey, Orion's got to restore the land to the original state prior to their mining. And they've made some projections about what the costs of the obligation are going to be. And whenever there's a sort of probability distribution, 30% likely this amount, 40 this amount, 30 this amount, the way we typically deal with that in accounting is just doing an expected value approach. Very similar to the way that you treated an aging schedule of accounts receivable, where if it's 30% likely I'm going to spend $250,000, then the expected value of that probability is $75,000. If it's 45% likely, sorry, 40% likely, if it's 40% likely that they're going to spend $375,000, then that amounts to 150,000. And 30% likely that they are going to incur $450,000, then the expected value of that probability is 135,000. Then I sum these together, I get 225, and I add 135, and all together, that's $360,000 is the expected value of the ARO. Now, it goes on to say that assume Orion's discount rate is 4%, and they intend on selling the mine in 3 years. Then I have an interest and a period to get a present value. And I'm going to go to a site really quick that has a present value calculator. You can use a present value on the calculator on the test. That's fine with me. The test will include tables that you can use as well. Either is fine. So here, this is just an online present value calculator that I pulled up. I know my assessment is a future value of 360,000. And I'm going to have 3 periods, 3 years. And I, assume that the annual rate is, I'm sorry, that the rate given is an annual rate, so I don't have to adjust it. And I don't have any payments. Payments would indicate that, not only do I expect to have $360,000 being paid, but I also have to pay $10,000 each year for those 3 years, or some, some additional payment. And that's not present in this. So we don't have to worry about that. After we've entered in all the fields, we just click on the one we want. And it turns out that the present value of the ARO is equal to 320,000, and I will just round $39. Okay. Now, the way you would have solved that with the table is if you had the table, you would take $360,000 and multiply it by a table factor. And you would look in the row and column that corresponds to n equals 3, I equals 4%. And you would get some coefficient that is less than 1, because you would multiply 360 by that table factor, and you would get something along the lines, after rounding very close to 320,000. $39. That's all that calculator is doing for me, is it's looking up the factor that corresponds to the terms I equals 4% and n equals 3, with no payments being extracted. So if that is my present value, then what additional entry must we make? What entry must be changed? What additional entry must we make? So we got to change the top entry. Now, not only do we have the natural resource, remember, it is going to be increased. This is part of the price of acquiring, part of cost of acquisition. So I'm going to add that to the 1,300,000. The equipment doesn't change. It's still just $30,000. Now, we don't just credit cash for this full amount. We didn't spend any extra cash. We still only spent cash of $1,330,000 for the costs aside from the ARO and the equipment. Now we have an asset retirement obligation for its present value. All it did was increase the value of my asset. It basically debited my asset by an additional $320,000 to bring it up to 1.62 million and some change. And now we have this liability in the future that we're going to pay. It's not cash yet. It's not being paid with cash yet. So it's just a future obligation. So that's how we would change the acquisition. Now at the year end, we would need to determine depreciation to the equipment, depletion to the natural resource. And again, we'll talk about that in the next part, probably next week. But we would also make an entry for, say at 12/31, for accretion expense and crediting my asset retirement obligation, because if this has been a year, then the present value of that obligation has risen. Remember that little plot that I drew on the prior page? It starts lower than the future value, and over time, the present value increases. Therefore, we had to increase the asset retirement obligation and record the expense of a liability increasing in value. And the way we do it is by taking the beginning book value of the instrument we're talking about. In this case, it's the asset retirement obligation, $320,039, multiplying it by the interest rate I used, which is 4%. And that gives me the buildup in the present value of this thing merely because 1 year has passed. Now, this is no cash amount. It's actually 802 if I round. This is not a cash payment that's due now. It is merely going to increase this value year over year until it reaches 360,000 at the end of 3 years. So what's going to happen at my ARO? It started at 320.39. I added to that 12,802, which is going to give me 334,841. That's going to be the new balance of my ARO. Then, so that's the new balance at the beginning of the second year. At the end of the second year, I would take this balance, multiply it by 4% again, record more accretion expense, and add it. It'll grow even further. That gives me a new balance for the year 3. And then at the end of year 3, I'd hit it again with 4% based on that new balance here. And what I'll eventually get is it won't be perfect because we're rounding numbers. So it'll be a couple of dollars off maybe, but at the end of it, the ARO will reach after 3 years, its value at that date. Okay. Now, again, this is, present value. Really got to think about it, really got to play with it and move it around in your head a bit and chew on it before it's going to make a lot of sense to you. It is something that is definitely very relevant, important, and significant in reporting any financial instruments. And in intermediate 2, you're really going to have a lot of accounting that deals with present values. And so the more familiar you get with the concept and how to manipulate them in an accounting system and what they mean, it'll just be lots of rewards and dividends to your future in the coursework. All right. Questions about that piece?